go back here, let's look at how we're going to analyze transactions. So we start by identifying these events. We know assets equal, what is it they equal? Liabilities plus stockholders' equity or owner's equity. You got it. So let's look at recording different transactions. We know that assets equal liabilities plus stockholders' equity. In stockholders' equity, we have, it's kind of like a conduit for a lot of things. Remember our income statement, how I told you it ties into the balance sheet? The way the income statement ties into the balance sheet is in stockholders' equity. Common stock or equity is the money that owners put into the company. But then there's this piece called retained earnings, and this is where your income statement ultimately flows into your into your balance sheet. So when you have revenues, it ultimately flows into retained earnings. Your expenses flow into there, and what you fork out for dividends flows against that. So do you see how we do have a separate income statement? But do you see how it ultimately balances out because it flows into stockholders' equity? Does that make sense? So let's look at an event. How many of you guys are with me? How many of you guys are like bored? Good. I got to play that song again if you get bored. Okay, so on October 1st, cash of $10,000 is invested in Sierra Corporation by investors in exchange for $10,000 of common stock. What do you think is going to happen to cash? Cash is going to increase. And what happens to our equity account? Our common stock increases, doesn't it? Do you see how on both ends we have an increase in assets, we have an increase in common stock? Does that make sense? On October 1st, Sierra borrowed $5,000 from Castle Bank by signing a 3-month, 12%, $5,000 note payable. What's going to happen? We borrow $5,000. What's going to happen to our cash? It goes up. What happens to our notes payable? Now we owe somebody, don't we? It goes up, doesn't it? Is it making sense? What I want to do, guys, is make this seamless for you. It can be simple. Let's keep it simple, so you just let's flow with the examples. Now, on October 2nd, Sierra purchased equipment by paying $5,000 cash to Superior Equipment Sales Company. What's going to happen? Cash is what? Going down? But look what happened to our assets. They went up, or the equipment. So do you see how our assets were affected in this? But it still zeroes out. It's just one asset replaces another asset. Do you see that there? Do you see in this one here, if we look at our equation, assets equal liabilities plus stockholders' equity, do you see our assets went up and our liabilities went up? And do you see in that first equation, when we received an investment, our cash went up and our stock went up? Each side of the equation has to always balance, okay? So with that first example, our assets equal liabilities plus owner's equity. Our assets are $10,000 and it equals because our stockholders' equity went up $10,000, right? In the second one, we borrowed money. Our cash went up $5,000. Assets equal liabilities plus owner's equity. Our liabilities went up $5,000. Do you see how we're always going to balance? But in this third equation, we didn't use liabilities or owner's equity, did we? What did we use? Assets are all we used. An asset went up, an asset went down. Is it still zeroed out? Make sense? Yes.
Where's that 12% go on the notes payable one? 'Cause like that's just the principal, isn't it?
That is correct. So let's talk about this economic event. What happened right now?
Borrowed 5,000.
That's it. Now, in a month from now, we might have to record interest that's accrued. But as of right now, what happened?
Just $5,000. But where would that go? Where would the interest go?
Good question. So let's say in a month from now, let's say we owe $50 in interest. Okay, 5,000 at 1%.
That accounts payable.
It would be our interest expense will go up and our accounts payable will go up. So do you see our interest expense is, I'm getting a little too confusing, but it will happen. It's an economic event. So let's move on here. On October 2nd, Sierra received a $1,200 cash advance from Mr. Knox, a client. What do we know about these cash advances? They're unearned. So what's going to happen with our cash? Goes up. What's going to be the other side? Unearned service revenue, or a liability, is going to what? Go up. Does that make sense? Now on October 3rd, Sierra received $10,000 in cash from Copa Company for guide services performed. What's this? Isn't this kind of like Martin giving me $1,000 to do his tax returns and his parents and grandparents? Mm-hmm. So when they receive $10,000, what's happening to cash? What's happening to owner's equity or stock or the retained earnings? It's going up too, isn't it? Do you see how the equation always has to stay equal? Make sense? So cash or assets went up. The retained earnings or stockholders' equity went up, didn't it?
What would be the title of that one?
Technically, cash is increased and it would be a revenue account, sales revenue or service revenues. Mm-hmm. But for purposes of right now, instead of putting this in an income statement, what we're trying to see is how that income statement ultimately flows back to the balance sheet. So we're just trying to help you see every transaction, there's something that's always got to equal out, okay? On October 3rd, Sierra Corporation paid its office rent for the month of $900. What happens to cash? Goes down. And what happens when we pay rent? Is that going to affect stockholders' equity? It's going to go down also, isn't it? It's basically a rent expense. But for this purpose right now, we're just showing how everything's affected. Assets go down and equity goes down there. Okay? Are we making sense? On October 4th, Sierra paid $600 for a 1-year insurance policy that will expire on September 30th. What happens to our cash? Goes down. And what happens to our stockholders' equity? Well, actually, what happens to our liability account? Oh, sorry, I'm wrong. Prepaid insurance, we're reducing cash, but we're increasing prepaid insurance. We're treating it as an asset till we use it up, okay? So assets went down and assets went up, didn't it? But did it change the equation? Assets equal liabilities plus owner's equity. On October 5th, Sierra purchased an estimated 3 months of supplies on account from Arrow. So what happens? On account. What do we know when it says on account? Did we use cash? No. So our liability went up, but what else went up? Our supplies or an asset went up. Does that make sense, guys? Who has questions right now before we move on? Are we good? Anything? Any questions? Concerns? Comments? On October 9th, Sierra hired 4 new employees to begin work on October 15th. What's going to go up? What's going to go down? This is a tricky one. Nothing. Why? No transaction. I'm going to run and get water real quick. Is that okay? One sec. Did I tell you everyone can drop one quiz? Did you know that?
No.
You'll be able to drop a quiz. Okay? So, if you're not, let's face it, we're going to have an off day or 2 or 3 or 4. So, everyone's going to get to drop something, okay? Unless you don't want to. But there's no sense in not trying to drop something. Okay, so hiring new employees, we decided no change, right? An accounting transaction hasn't occurred. An economic event has not happened, has it? Right? Now, on October 20th, Sierra paid a $500 dividend. What's going to happen there? Cash is going to go down. Equity goes up. Think about it. Equity is going to go down also. Why? We're not bringing more in. We're getting rid of something, aren't we? Does that make sense, guys? Yes? No? Okay. Cash goes down, and our stockholders' equity goes down because we're forking it out. Employees have worked 2 weeks, earning $4,000 in salaries, which were paid on October 26th. What's going to happen there, guys? Cash is going down, and what else is going to go down? Equity, or an expense, which is ultimately stockholders' equity is going to go down. Is that making sense, guys? Next one. Oh, we're done. So what are we going to do now? Let's look what we're going to do. We are going to add up all of our columns, our cash, our supplies, our prepaid insurance, our equipment. These are all assets, aren't they? Assets equal what? Plus owner's equity. Let's look at our liabilities. Notes payable, accounts payable, and unearned revenue. We've got here all of those combined. And then, here, let me do something here so I can darn. Well, this is a better way to see it all. For some reason, I can't. Okay, let's see if this works. Shoot. So, basically what I want you to see is when we look at our liabilities and look at our notes, accounts, and unearned revenue, and then we add up our stockholders' equity, do you see, guys, that our assets of 23.3 equal 23.3? Do you see how it all balances? Isn't that the way it's supposed to work there?
Yes.
Okay, so our 23.3 of assets equal our liabilities plus stockholders' equity there of 23.3.